Welcome to another episode of the 10,000 Trades Show, where we are mastering trading and creating excellence through the deliberate practice and analysis of 10,000 trades. In today's episode, we'll take a look at an inefficient market move. We'll learn what an inefficient market move is, how to identify these moves that happen really suddenly, and what exactly are we looking for in terms of placing our trade, where to enter the trade, where to exit the trade, and how to book a profit in this type of a trade setup. Here we are looking at how to trade an inefficient market move. An inefficient market move is when price moves suddenly, and usually this is a result of either comments from a high official, or it could be news that comes out. Usually this happens during low liquidity conditions when the market is not very busy, and we see that small things can have a knee-jerk reaction. So we're looking for a quick move. In this case, we see that price just took off from here and moved all the way up and didn't really stop. So an efficient move is more like this, where price goes back and forth. An inefficient move is where price takes off suddenly. So first step here is to identify an inefficient move, which is this over here. And then we're looking for price to stabilize. So we need to see that it's not moving up higher, because what we do not want to do is try to catch a falling knife. So we do not want to just start shorting this while the price is moving up. So we need to wait for price to stabilize, and here we see that price is going sideways and it has stopped moving upward. So there's no more momentum left in this move. And this is a 1 hour chart, so this is over several hours. So what we see here is this is a nice pin bar here. Price has moved up, but it does not want to move any higher. That's what the pin bar shows us, that price is rejecting that level. And then we have a bearish candle close, so we can either take a trade here, over here at the close of this candle, or at the close of this candle here. So after price has stabilized for multiple hours here, we see a nice bearish engulfing candle close here. So this is a good place for us to enter the trade short. So we can either enter at the close of this candle or wait for a bit of a pullback to enter the trade short. And our stop would go above the pin here. We just want to make sure we give it a little bit of room in case price decides to go and test the level once again. So we enter the trade short and we stay with the trade as price moves lower. We will put our target at the base of this candle. This is where price took off from. So we'll just put that target in as soon as we enter the trade, and then we just wait for price to come and take our profit target. So that's how we would trade an inefficient market move. So just to recap here, an inefficient market move is when price moves up suddenly, or it could be to the downside. In this example, this is a bullish inefficient move here. And then we're waiting for price to stabilize. Once we see that price has not moved up higher, there's no more momentum left in that move, we're looking to trade the price in the opposite direction of this initial move. So we're looking to short this here, and we wait for a nice bearish candle here. In this case, this is a nice bearish engulfing candle, so we can take our trade short at the close of this candle. Our stop would go above the pin here, and we put our profit target at the base of this candle. I like to put it a few pips above the base here, just to make sure that it gets taken in to accommodate the spread there. So we put the target in as soon as we enter the trade, and then we let the trade run. So in this case, from entry to exit, we have 198 pips in the trade. So our profit is 198 pips, or $1,980 when trading one standard lot. Thank you for joining me today. I hope you enjoyed this episode. If you like this video, please feel free to share it with your friends, and like, comment, and subscribe below. And I'll be back with another great episode next time.